Hey, welcome to the podcast, everybody. Thanks for joining me. Appreciate it. Well, the market is closed on this crazy, wild week. It's October 7th, and the market is now closed, so I can finally take some time to update you on what I've been doing, what I'm thinking right now, and it's very difficult right now. There's no question about it. You know, today was another crazy day where the markets were celebrating that there was more jobs created. Of course, a lot of those jobs created this morning were the fact that a lot of striking employees came back to work. So they were taken out of the numbers last month, and then they were added back in the numbers this month. But overall, the number was higher than expected. But, you know, when you dig down and look in some of these numbers, you still are seeing the underemployment going up higher and higher. In fact, that number is 16.5. So, you know, the unemployment rate still under 10, but the underemployed is 16.5%. And again, that, for those that don't know, those are people that are either temporarily out of work and have given up looking for the time being, or people that are part-time that wish they were full-time. You know, I went into a sandwich shop not long ago. I think it was a Quiznos or a Subway or something, and a lot of the employees in there were people that were much older. And it just shows you that in this environment, those are people that more than likely would like to be doing something else other than putting sandwiches together, but they're doing what they need to do right now. Those are underemployed people. So that's 16.5%. So it's going up. The duration of the length of time that people have been unemployed, that is also rising. So you're really having more and more trouble here. The economy is not getting better, yet the market initially celebrated the fact that this number didn't crater. And I really think when the market's oversold, it takes any little bit of good news and it runs up. And we saw that earlier in the week, right? We see anytime a piece of economic data comes out, it's slightly better than estimates, and it's still a bad number, but it's better than estimates, and so the market goes up. And especially if it's oversold, or if there's a rumor, the market goes up. Well, earlier this week, the stock market did kind of break out of this box. You know, we've showed you this box before. We had been trading in it. I'd basically been shorting when the market ran up and covering those shorts when it went down. Had a little whipsaw earlier in the week because we did break down. You can see we broke out of the box, put back on some shorts after covering them that morning, and then was stopped out within just a few hours simply because the market went the other direction. It was a good thing because the market went up two more days. It went up on Wednesday and Thursday. Today it was up, I don't know, maybe 100 or so. Then we were down 60 on the Dow, and then up 100, and then finished down. It's just finished down 20 on the day. So you're really getting more volatility than I can remember, and it's, again, more directionless than anything. Now, when I say that, don't laugh. What I'm pointing to is I've got the 21-day moving average up there. When I say directionless, you know, once we've come into this box, we've essentially been moving sideways from point to point. The blue line is a 21-day moving average. And you can see it's been moving sideways in the last couple of weeks. It's taken a little notch down. But more importantly than all of this is zooming out just a bit and really looking at the internals of the market. And what we have noticed is that there are still people out there that are very antsy to sell. I mean, I talk to people every day that still have 100% of their money in mutual funds, believe it or not. And they simply are going up and down at the whim of the market and have probably fallen 20-25% from where the markets were. And yet those people haven't sold yet. At some point, they sell, and they typically sell very, very, very close to the bottom. That happened in 2008, happened in 2000. That'll probably happen again at some point. But the point is, every time the market rallies, it's met with some selling just as it was today. Better than expected economic news for the bulls, and yet it was sold into. And you could say, well, yeah, but it was probably just profit-taking from the week's gains. Maybe, but we did have a little higher tick on the volume, as you can see. The red here is the volume, a little higher. And we really had a nice volume day and that reversal day, but there wasn't any follow-through. And see, that's really what you want in a bull market, as we've said, where a market's either correcting or it's in a bear market. What you want is you want the market to get flushed out, maybe as it did Monday or Tuesday. You want it to turn around, and then you want that follow-through to come. And the next 2 days, Wednesday and Thursday, they weren't awful days. They were good days. They just didn't have the same ferociousness that you would typically see at a bottom. They were okay. We had a 90% upside day yesterday. 90% of the volume was up. We had 90% of the stocks up and so forth. But it did not have the volume associated with it. As you can see, the volume was pretty much the lowest of the week yesterday. So based on the spiders anyways. So we're still seeing some internals that are weakening, and I still think this is ultimately a market that you're going to want to sell into. Now, you do have a fork in the road if you think this is a bear market where you simply sit out, or do you try to trade a little bit, earn some money, hedge yourself, use some shorts and so forth. And I think you do a little bit of all the above. But I also think don't overcomplicate things, because this week was a perfect example of how you can get whipsawed. And I was whipsawed on a trade this week. I had a nice short position on, locked in a profit, put it back on, and then took a loss on that one. And that happens. But you got to stay in the game. When it broke down out of this box, this thing was really falling fast. On Tuesday, the market was down. The Dow was down 220 points at one point, and then finished up 150 on the day, and that came probably within the last 30 or 45 minutes of trading. So extreme volatility. But it's really difficult right now because, remember, you have hedge funds out there that are probably down 20, 30, 40% for the year because they've made big bets on commodities or emerging markets or whatever, and they're down a lot. And they've only got a few more months to make their year. And so they're in a race. And so they are simply fading these markets, trading them, and when they short, they really short hard. When they go long, they really go long hard. And they're really causing the markets to have extra volatility, which in turn gives us extra volatility. And I think the most difficult thing in this environment right now is the fact that pretty much everything has a correlation of 1, right? In a normal market, certain things move more, certain things move less, certain things go up, certain things go down, some pay high income, but you are able to identify and spread your money out. In this environment, what we have right now is a correlation of 1, where REITs go down, preferred stocks go down, convertible bonds go down. You know, you could have tech stocks go down, small cap value, large cap growth. They're all moving together. Even gold now is struggling, right? That was a place to hide out. Apple was a place to hide out. Now it's going down. So really what's happened is you just have treasuries moving on their own and then everything else. And so when it's a good day, everything tends to go up. When it's a bad day, everything tends to go down. And that's not a typical market, right? Typically, diversification works pretty well. Not diversification the way the mutual fund salesman would tell you, but really diversifying with, preferred stocks, convertible bonds, closed-end funds, common stocks, large cap tech. All mixing those up does work well at times. And then obviously, leaning towards one direction or another. Right now, it's a correlation of 1. So if you expect the market to go up, you simply you could buy the spiders or the Qs. And if you think it's going to go down, you can short or go to cash. So the diversification in the short run isn't working, and that's reminiscent of 2008. So I think elevating the cash levels is important. And again, trade around the markets if you wish, but definitely keep tighter stops, especially going into the weekends and so forth. It's hard on the weekends because you could get some type of bailout this weekend and then come in the markets up 300 points on Monday, or just the opposite can happen. But generally speaking, make sure you keep things tighter than you have in the past. If something's not working, it needs to be out of the portfolio. And if you do want to keep investments, hedge them at times. So I don't expect the volatility to necessarily change. I think overall you're going to see still a very volatile market, as we talked about, but I think that the path of least resistance in the bigger picture is still going to be down. And that's just based on not only the economy getting worse and the leading indicators continuing to struggle, but I think overall the Greek situation is getting worse, not better. And then actually, like I said, the internals of the market are still in the big picture not very good, meaning there's too many people still antsy to sell based on the stocks participating, the stocks going up versus down, how much volume is associated with the up versus down. All those things lead me to believe that we are are going lower. Now, with that said, as I've always mentioned in the past, it's about time frames. And when we think about the bigger time frame of being perhaps in a down negative bear market, and then we look at the short run, we say, boy, there's been a little strength this week. But look, we have the 50-day moving average. I showed you the 21-day moving average just earlier just to show you how flat the market's been in the past. But the 50-day moving average, of course, everybody watches that. And you can see that may be why the market ran into some trouble today. You know, we hit it, of course, back on the 19th or 20th of September. And then here we hit it or got very close to it today. So that's something people are watching. If we break through that or get some type of weak pullback next week and then we break through that, we could have a few weeks of a rally. But that doesn't necessarily mean we're not in a still a bear market or a tough market that should be eventually sold into. So you have to stay real flexible here. But that's why I've been saying keep stops and so forth. But don't just necessarily sit in all cash, because there are opportunities out there, even if they only last for a few days or a few weeks or whatever the case. All right, well, we saw this week, of course, Steve Jobs passed away at a young age of 56, and, you know, this guy leaves behind a legacy of innovation, creativity, I mean, just pure genius, and a great CEO, too. And, you know, obviously he didn't put all the stuff together and didn't come up with every single idea, but he had a vision of what he wanted it to look like and then got the people to do it for him. You know, I think certainly having leadership in our country that would mimic some of those characteristics wouldn't be a bad thing right now. But certainly his passing wasn't a shock. I think the timing of it was, you know, when he was out just seems like 2 months ago introducing their new operating system, Lion, and then we get this news the other night. But, you know, has Apple peaked? I mean, is this the peak of the company? I mean, let's go through some of their statistics. I mean, you got a company here that's got a market cap of $350 billion. They've got cash and short-term investments of $28 billion. Their earnings are expected to grow 83% this year. Their long-term growth is about 22%. They got a PE ratio of only 19, including the cash. Estimated, PE going forward is about 14, 13 based on their earnings. Return on equity, 35%, no debt, and free cash flow of $11 per share. So this is a company that has, I mean, everything you would look for. They're selling products that are very unique. They're growing very fast. They don't have debt, great leadership, etc. But has the company peaked? And you know, more importantly, has the stock peaked? And let me just say, I think from my research and what I have found, I think they have at least 2 years of products in the pipeline, if not about 5 of vision. Now, do they have every single thing mapped out exactly the way it's going to work, you know, and have the iPad 5 already in the pipeline or some new device we don't know about yet? I don't know. Probably not, but I think there is a template and a map, so to speak, of what Steve Jobs left, and he said, hey, this is the way I want it to look. This is where the future is going to be, and we need to make sure that we have the products to take advantage of X, Y, and Z. And here's what I have in mind. I think that's happening. So I think for the next 2 to 5 years, Apple's going to be run and really has so much momentum that it's going to run just as it did before. But it had a couple of things going wrong with the stock this week. I mean, number one, we've had a rough market. Number two, they didn't come out with the iPhone 5. They came out with the 4S, which is a great device. I mean, but it's not going to make me run out and get it because I have an iPhone 4, and for me to get a better camera, and be able to tell it to set the alarm clock verbally, those are neat little gadgets. And when it's time to upgrade, great, but it's not a wow factor. So now they are on Sprint's platform now. So it's going to get out there, but a lot of people wanted it to maybe be a cheaper device. But what they did instead was they said, let's make their iPhone 4 $99. So now that the one that was the greatest and latest thing last year is going to be $99. So we'll see how this plays out. But I think they do have other things going on, and I don't think it's a reason right now to sell the stock. So I don't think the stock has peaked. But I do think when you think about a company and the natural maturation of a company, what happens is you go through this high growth phase, and it looks as if the stock is going to go up forever and the company is going to continue to grow forever. And what ends up happening is, at some point, the law of large numbers catches up to them, and they can't quite produce. They have this, they have obviously great market share, and they continue to increase that. But there is a point at which products overlap, cannibalization. There's obviously the earnings just can't grow at that same rapid rate, and you've seen that with Walmart, Microsoft, Intel, Cisco. And what happens is a lot of those companies are hated right now. Intel, Microsoft, Cisco. Starbucks went through this. They are very fast-growing companies, but then it slows down, and people really slam the stock. I think Google's going through that right now because they're still a growth company, but if they don't produce the growth, the stock goes down. But what happens is those companies at some point become values because they haven't gone up in years, and they're still producing tons of free cash flow and great return on equity, and the stock's, the company's fine. And so the stock just becomes too cheap based on what the company is really worth. And I think that's the case with Microsoft, Intel, Cisco, Walmart, even Coca-Cola. I think those companies are great long-term values. Why don't we load the boat on them right now? Because of the fact that we're in a tough stock market, and many stocks, while they may hold up on a relative basis, still tend to go down. And I think Apple will get to that point. I don't think it's just yet, but they're going to get to a point where they simply can't grow fast enough to satisfy investors. But the interesting thing about it is, they've got a forward PE of 13 or 14. So this is not a company. I mean, even Walmart back in the day had a PE of 40. Even Coca-Cola had a PE of 40. I mean, and those were well-established companies. So Apple is still a relatively cheap company given everything they have going for it. So it's not a time to necessarily sell the stock. We do want to take a look at it from a technical perspective, though. And as you can see, I mean, it has sold off from the 420 range, went all the way down to 355 yesterday or so, and has bounced up to about the 369 level. So it's sitting here kind of where it was back in August. But here's the fascinating thing about Apple. I mean, obviously in the white we can see the stock has been straight up. It's gone from, $100 a share over here all the way up to, over 400 here recently, just since the beginning of 2009. But here's the thing. The valuation that you're paying, and I've showed you this chart on other companies before. This is in yellow is the PE ratio. Excuse me, in green. A little colorblind here. It's Friday afternoon, a little tired. But in green, the valuation's gotten cheaper. I mean, the PE ratio is 14 now going forward, and here we are. It was 25, 24 back in 2010. So again, can they keep delivering the earnings? And I think they can, for sure. But you're not paying an overwhelmingly expensive amount for the stock. And I think a lot of people, all they see is the stock price. So it's not a reason for me to sell it just yet. Again, though, keep in mind that when the stock market, if it gets really, really bad, all stocks are not spared, right? Every stock tends to go down. So it's not to say we won't ever sell Apple, but it's to say let's give it the benefit of the doubt right now because it's not a very expensive stock. It's actually a pretty cheap stock for what you're getting. If you simply look at just the 200-day moving average, you can see it's bounced off it in August, bounced off it in June, and it went a little below it, and then it kind of bounced off it the other day. Maybe you wait for it to the moving average to flatten out a little bit and go below it, and then if you want to sell it, fine. I mean, look, the thing is, we want to be long-term investors. That's an easy way. We wrap our brains around it, right? We say Apple's a great company. We're going to invest in it. Unfortunately, you have to realize that we're not in a market right now that rewards people for investing. And that's really sad, but that's where we are right now. We're in a cyclical, a secular, sideways, choppy, tough environment. And I think that we will get into a buy and hold environment in the future because it'll be dead, right? We know buy and hold's kind of dead right now. At some point it'll come back. We're not there yet. So for the time being, we can't be married to any stock and say, I'm going to keep this through thick and thin because Apple could be a $250 stock. And if you were somebody that bought it at $380, $400, then, you don't want to be riding it down to $250. Even if you bought it at $250, you don't want to be giving all those profits back. So there may be a time that we do sell it, even though it's a great company doing great things. And I do think from what I've been researching, that TV is going to be a big part of what they do. They have the Apple TV, which, for those that don't know, is not an actual TV. It's a little box the size of a hockey puck, and it hooks up to your TV, and then it wirelessly grabs all of your content from your computer. You know, you can grab your pictures, it can grab your, through iPhoto, it can grab your music, it can grab your television shows, and you can just simply watch your home movies all with a remote control. So it hooks up to your TV. So it's really a neat device, but there's probably something bigger with that coming, and I really think that may be the next boost, not necessarily an iPad 3. So they've got other stuff up their sleeve, no question about it. But if the market is super horrible, Apple's going to struggle just like every other company. The other thing to think about here in the short run from a technical perspective is not only did it bounce off of its 200-day moving average, as you can see, but it also, you know, here's the old breakout level based on, you know, it obviously peaked back in February, and it was working its way down to June, and then it just went straight up, and then it bounced. So, you know, that could be your line in the sand, which would be kind of the 355, 360 level. And it did go through there the other day, but let's call it 349. If it goes through that, maybe that's your level where you say, "Uncle, you know, enough," and then I'll revisit it at some time. But hey, if there's a handful of companies that you're going to keep through thick and thin, and you know, and you can put up with some volatility, Apple should still be that company because it still is such a company that's got such goodwill in the community, right? And it's also it's not expensive, and it's got great things going for it. So there's no question, though, it's a different company without Steve Jobs than it was before. You could see the presentation the other day. Granted, Tim Cook, the new CEO, obviously knew that Steve Jobs was hours away from passing away, and he had to go out there and put on a happy face and unveil a new product. Worst, you know, circumstances you could think of, but they couldn't delay having to, you know, to do that. I mean, they had that scheduled, and they did it. Very sad. But anyways, he'll be missed, and but the company itself at this point is still in great shape. All right, guys, I'm going to keep it brief. Very volatile week. Still playing defense more than offense here, and I suggest the same. Take chances on some individual companies, though. There's some charts setting up and so forth. But, again, keep the stops really, really tight. And remember, we're going into earnings season now. And not only what they say, but what they about the past, but what they say about the future is going to be huge. And if these companies have some negative things to say, look out below because it's very vulnerable right now. All right, take care, everybody. CarlEggers.com, Twitter.com/CarlEggers, Google+, I'm on there, and EggersCapital.com.